Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Alix Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
I'm Paul Sweeney.
And I'm Nora Melinda, filling in for Alix Steele.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at why luxury maker LVMH posted weaker than expected sales last quarter.
Plus, we'll discuss how the tech company Intel is now making good on plans to start spinning off non-core assets.
But first, we begin with the drug and pharmaceutical space. This week, Pfizer terminated development of its obesity bill after a patient in a clinical trial developed signs of liver injury.
This raises the odds that the drug maker will spend billions on an acquisition to break in the blockbuster weight loss market dominated by Novo Nordisk and Eli Lilly.
For more, guest host Emily Grafeo and I were joined by Mikey Shah, Bloomberg Intelligence Senior Pharma-Biotech Analyst. We first asked Mikey how big of an issue this recent news is for Pfizer.
Yeah, I mean, I think it's a sentiment issue. I mean, clearly, you've got a massive obesity market out there, $100 billion plus in terms of size. And it's a market where, Pfizer's already kind of trailing large pharma peers like Lilly, Roche, Novo. In terms of, the obesity pill itself, so this was danuglipron. So what they actually did was it used to be a twice daily pill. They kind of canned that and repurposed it into a once daily following the failure of another one of their obesity pills, lotiglipron. So I'd say, confidence into this readout, was pretty low. We had already kind of removed it from our models, back in 23. But what it does, create is, two concerns. One is, the trailing timeline in the obesity space. And two, it kind of adds to the mid to long-term growth worries of the company. So they've got, about $15 billion in lost revenue to LOEs that they'll need to kind of offset over 25 to 29. And at the moment, it's quite hard to see, where that offset and where that additional growth is going to come from long-term. Obesity would be kind of one pillar. But, following the danuglipron readout today or the news today, that's obviously been terminated. So, we think that they're going to have to go to, look to, external assets in the obesity space if they're going to remain a relevant player in that market.
Mm-hmm. Is anyone else doing obesity pills in this market right now?
Yeah, so I mean, there's a few biotechs out there that are doing pills. In terms of the large pharma competitors, Lilly's got one. We'll see the data for that this year. Phase 3 that could potentially launch in 26. Novo's got one. They're expected to file. And then Roche also has one kind of in early to mid stage development too. On the biotech front, we're seeing moves for Viking, Structure, Terns, and they all hold oral GLP-1s in their pipeline too.
Hey, Mikey, can you put into just perspective the size of this obesity market relative to other big verticals that drive these pharma companies?
I mean, I think the excitement around obesity is, one, it's prevalence is rising. You got 40% of US adults at the moment that are obese, and it's a relatively underpenetrated market. So I mean, penetration rates are low single digits, in the US at the moment, probably even lower elsewhere, globally. We think that this market could grow, well in excess of $100 billion. So yeah, I mean, it's a massive opportunity. I think in terms of, drug classes, I think immuno-oncology, PD-1 drugs, were the kind of biggest class to date in terms of sales. So that's like your Merck Keytruda, Bristol Opdivo. But, GLP-1s could potentially surpass that.
So, Michael, where does Pfizer go from here after this setback? Do they double down on obesity pills? Do they try something new? What's the plan here for Pfizer?
So, I mean, they've got another oral GLP-1 in their pipeline, so it's in phase 1. It's being developed for diabetes. Not sure, whether or not they can also look at that in obesity too. But clearly, the timeline here is the issue. You've got oral GLP-1s coming to market in 26 onwards. You'll probably have a wave of new treatments coming in, towards the end of the decade. So, we really think that Pfizer's going to have to go out, either in-license a GLP-1 or do some sort of M&A. They're well positioned to do that. They've got 10 to 15 billion of M&A firepower, for acquisitions. So that's really, how we think that they're going to do, play catch up in this space. In terms of, I mentioned some biotechs out there that have, quite appealing assets. You've also got China too. So, we've seen some, very competitive data in Chinese patients for some of those domestic players. And, we've seen the likes of Novo, Astra, Merck all delve into China's R&D locker to essentially bolster their obesity pipelines.
Our thanks to Mikey Shah, Bloomberg Intelligence Senior Pharma-Biotech Analyst.
The trade war between the U.S. and China has been heating up. This week, China ordered its airlines to stop taking deliveries of Boeing jets and to halt purchases of aircraft-related equipment and parts from U.S. companies.
The move is seen as a retaliatory measure in the ongoing trade war between the U.S. and China, which has imposed tariffs of up to 145% on American goods.
For more on Boeing, Nora and I were joined by George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst.
We first asked George how big of a deal this news is for Boeing.
I don't see it as being a big issue, right? So this is one of those things that the relationship has deteriorated over a period of time. We took another look at when we saw orders from the Chinese airlines for Boeing, and there's been like 15 or 16 this decade. I think 15 came in, I think, last year, of 242 orders from China that are on the books right now. The last real material size and orders from the big Chinese airlines we saw back in 2018. So this is a relationship that's been broken for a while. Frankly, the Chinese haven't really been, like I said, ordering from Boeing. So the bigger issue here, I think, is Boeing delivering some of the airplanes they've already built for the Chinese. Like I said, there's some 240 of them sitting in the order books. I suspect a bunch of them are already made, and Boeing would like to get rid of them. Part of the shadow factory elimination they're trying to do to streamline operations. It's a pain in the neck to have an airplane on the tarmac that's sold that you've got to maintain, but the customer isn't taking delivery of. It'll slow that down. I think it might hasten some of Boeing's push to sell some of those airplanes. The Indians have bought a bunch of them. Maybe they're game for more. But I just don't. This is China admitting what they've already been doing, frankly.
So, George, what exactly is the goal here? I mean, to your point, and also Jefferies analysts, they're noting that Boeing has largely de-risked from China. They said that the country contributing roughly about 5% of the skyline over the next couple of years, but also a source of upside. What do you think the goal is here if there seems to be marginal impact here to Boeing?
Yeah, look, I think it's splashy, right, for the Chinese to make this kind of commentary. And look, I do think there's potentially some upside. So look, there's a couple things that's been going on, right? China, one, is growing a lot slower since the pandemic. Prior to the pandemic, China would take in 300 narrow bodies a year. More than half of them would be Boeing. And so, since the pandemic last year, we saw about 150 deliveries of narrow bodies into China. They were Airbus airplanes. So, and look, in a global trade battle, China could see a diminishing GDP, right? This is a country growing 8% last decade, 4-ish% this decade. But if they get that, if they decide they're going to negotiate with the U.S., they get some of that growth back on the rails. I think inside some of that negotiation, you could see a requirement to order Boeing airplanes. Donald Trump cut a similar deal in his last administration. So there is some silver lining. And like I said, I think the Chinese they know that Boeing's one of our biggest exporters. They know they'll get some good headlines out of saying we're not going to take any more Boeing airplanes. But again, I think this is a microcosm of the U.S. economy getting uncoupled from China right now.
So this isn't a major headwind here for Boeing, but what do you think are some headwinds that they could be facing? What are some near-term hurdles?
I think Boeing has been down for so long that I think most of the hurdles are clearing and you're going to see a pretty good year. I think the big issue this year is they've really got to get Spirit Aerosystems bought and integrated into Boeing. I think that's well underway. I'm hearing good news from people I know in the industry about quality coming out of Spirit. They've got to get rid of that shadow factory. There's airplanes already built sitting on the tarmac that they're maintaining. That's just a huge drag in expenses. They got to get them delivered out to customers, sold off to new customers, and it's all about in the back half of the year building more airplanes in the factory. We've been watching it in the first quarter of the year. I think they're getting about 20, 25 through the factory every month. They got to keep building on that cadence. That's going to generate the cash and the profitability they need. And oh, by the way, they added $26 billion to inventory since I think 2018. We have it in this report. It's some 500 equivalent to 500 737s. As they start building from the inventory on hand, their cash generation is going to be supercharged. They could have a really nice back half of 2025.
Our thanks to George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst.
Coming up, we'll break down why Elliott Investment Management is said to be building a stake in Hewlett-Packard Enterprise.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go in the terminal. I'm Paul Sweeney.
And I'm Norma Linda. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Paul Sweeney.
And I'm Norma Linda, filling in for Alix. We move next to the luxury sector.
This week, LVMH shares dropped after the luxury group published weaker than expected quarterly sales.
The company was weighed down by sluggish demand for high-end goods in China and the U.S. and an escalating trade war.
For more, Nora and I were joined by Deborah Aitken, Bloomberg Intelligence luxury goods analyst.
We first asked Deb what she took away from LVMH's most recent results.
Fashion and leather goods is 50% of their sales. So actually, this is a Q1 organic sales growth figure only, not the earnings. And we saw with fashion and leather, it was down 5%. The market had expected down 50%. And what we saw behind that, the US is holding up okay, so's Europe. But where they did a big chunk of their business last year from tourism shifting across from China to Japan, that's now dried up against 2 years of big numbers. And the big thing is that it hasn't repatriated back to the mainland. So that was one side. Another side for them would be, if we think about the wines and spirits division, which houses their cognacs, that's still very tough in the US and also in China. And then Sephora was a big growth driver last year for them in the US. That's kind of fallen away a little bit on the big comps.
So, of course, we know weakness in sales in China has really been an overhang for LVMH and just the broader luxury industry. But the EU expects U.S. tariffs to remain as talks make little progress. So that being said, how are a lot of these luxury companies really thinking about this tariff environment and the uncertainty there as it thinks about the U.S. consumer?
We've done certainly a lot of our own work on Excel, dug deep, gone through all of the different factors. And we can see when we look at these companies, a range of maybe 2 to 8% in terms of need and price rise. So the highest end companies have the biggest margin. So therefore costs are lower and generally they're operating out of Europe. And so that means that they would need to price probably low to mid single digit to cover that, given that currently across Europe, we have a 10% tariff risk hike. Of course, that could change. But, it's going to be difficult because the last 3 years, we've seen price hikes of 25%. So since we've had a pandemic recovery. So they really are running off a very high base on the pricing. They're going to have to really determine what they do in terms of more manufacturing over there where they can. So for mid-range, for some of LVMH's fashion and leather goods, we think around a third of their US is covered in terms of US sales versus production, but there's a long way to go. And it can't be done quickly because you need really good artisans and to be training in labor. And that's one of the biggest issues for these companies.
I'm looking at the PGEO function on the Bloomberg terminal, and I see that Asia, excluding Japan, makes up about 27% of LVMH's business. So it's material. What are they saying about China? Is this a market that they can depend upon being a growth driver going forward or not? Because I know just from reading your work and talking to you in the past, China's really a linchpin for global luxury.
Yeah, I mean, the big thing and the big hit over the last quarter, really, in these share prices has been that the second half of last year, we saw the US really start to improve, and that was offering a bit of a lifeline until we could start to see China, hopefully by the second half this year, improve that, or that changes, the mindset changes, the consumer sentiment changes. And so, yes, for the long term, there's still a lot to do for all these companies, and each of them will say they still pin their hopes on China for the long term, more infrastructure into the marketplace, owning the consumer more over there. But certainly in the short term and in the year ahead, there's so much uncertainty. And I really think that hits hard on consumer sentiment, not only in the US, but also and particularly in China. Another one we saw was Beiersdorf with Nivea, and the very high end La Prairie came out. And I'm just trying to get a feel of how beauty is doing over there. And the view there is that they've had to clean up China even more on the La Prairie brand, which is very high-end skincare. And they're having to actually also think about Nivea and rebranding it to at least the premium level. So there's more price volatility in the market, and that's already starting to creep up in China.
Our thanks to Deb Aitken, Bloomberg Intelligence luxury goods analyst.
This week, we focus on a Bloomberg Big Take story titled GM and its 8-year, $35 billion EV bet brace for tariff hit. You can find that on Bloomberg.com and the terminal.
The story looks at how General Motors has to figure out how to sell cars in Donald Trump's America after spending about $35 billion on its EV transition.
For more, Paul and I will join by David Welch, Bloomberg Detroit bureau chief.
We first asked David to break down why times are tough right now at GM.
If you look at Trump's policies, they're pretty tough on all the car companies, right? I mean, you've got this tariff regime out there that still hasn't been sorted out. Trump has indicated that he might have some leniency in the offing for car companies, but they've built up the supply chain and assembly in the US, Canada, Mexico, and other places for decades now. They have made more investments based on USMCA, which was a Trump trade deal, and now that could be upended. GM makes 2 of its EVs in Mexico. It's 2 of its cheapest ones, the Chevy Equinox and Chevy Blazer. And so it makes it tough from that standpoint for those 2 vehicles. And some of the parts that come in for those vehicles. And then generally for GM's business, tariffs are just not a good thing. They import vehicles, they import components, all of that. That makes it tough. Trump has also said, he hasn't done it yet, but he said that he wants to get rid of the Biden-era Inflation Reduction Act. Those are up to $7,500 in tax credits for people who buy EVs. That makes GM's life difficult with this big investment they have out there. There could be relief on this. There are ways to get around it. But if you're General Motors and you've got a dozen EVs out there, and the program on the whole loses money, they're improving the profitability, but it does lose money. You know, the pressure's really on, as it always has been, but even more so with Trump policies, to get those vehicles to a break-even or a profitable level and then sell them in big enough numbers where you continue to get economies of scale and you can drive the cost down. So it's not impossible. They're working hard at it, as we have a lot of detail on in the story in terms of reducing battery cost, improving efficiency at the assembly plant level, that sort of thing. But it's hard work, and EVs, this kind of transition was always going to be difficult. It is for everybody. But you know, in GM's case, they've done some reining in of investment, but they've really continued their push, and some of their rivals have reined it in, pulled back in the face of all of this. So GM's sticking with it, and they're really working hard to make it profitable.
David, as you said, the pressure is on. Does CEO Mary Barra really have a dog in this fight to electrify GM in the EV space? I mean, of course, she's trying to get a little bit of a peek into Tesla's playbook by hiring some of their veterans from Tesla. But do they really have the brand recognition that they need to push through on this charge?
Yeah, that's a tough one. I think what they're trying to do here is they're trying to change that, right? So one thing they'll point out is, one, they doubled their market share in the EV segment, EV space in the U.S. over the past year, and they did even better in the first quarter. So they've got some sales momentum, and they're doing better on the coast, which is where most EV buyers are. But it is a bit tough when Chevrolet, for example, known for big pickup trucks, known for Chevy Suburbans, Cadillac, known for the Escalade. These are pretty thirsty and pretty expensive vehicles. They tend to do well in the middle of the country and in the South. So for GM, you can see why they want to push this, right? They've got brands that do better in middle America. And if EVs are bought on the coast and you can get market share there, why wouldn't you push for that? It does bring in a different kind of buyer. And I think there's a bit of chicken and egg here. Does the brand hurt them from selling EVs, or does selling EVs help get recognition for these brands with people who didn't look at them before? And I think that's the case they're making. And they're having decent sales success, so there's a bit of momentum there while they're trying to do it.
David, tell us about the Ultium Cells factory outside of Nashville, Tennessee.
Okay, it's very similar to the one in Ohio, and it's fascinating to walk through. These are pretty well automated operations. It's not like when you walk into an assembly plant and you see workers swinging a set of seating for the interior over on robotic arms and putting that in, or bolting engines. Like, they're watching computers, they're watching automated machinery that mixes chemicals or puts that chemical slurry onto a metallic sheet to make parts of the battery components. A very different type of thing. If you walk through a battery plant, or I should say a cell plant, it's kind of more like a chemical facility than it is like a traditional assembly plant.
Our thanks to David Welch, Bloomberg Detroit Bureau Chief.
We move next to news on the IT company Hewlett Packard Enterprises.
This week, we heard that Elliott Investment Management has built a position in HPE worth more than $1.5 billion. Our data shows that the investment makes Elliott one of the company's top 5 shareholders.
For more on this, Nora and I were joined by Jin Ho, Bloomberg Intelligence Senior Technology Analyst.
We first asked Jin what this investment by Elliott and HPE is all about.
It looks like Elliott is looking for an opportunity here to create a stake in terms of possibly extracting more cost actions from HPE, especially when the company is going through a down period from an execution standpoint, as well from a demand perspective as well.
So what exactly are they really wanting to do here through this investment as an activist investor? What do they want to change?
That's a good question, Nora. I mean, look, one of the things that I think they're doing is trying to extract more cost actions. One of the things that HPE did after their execution fumble last quarter was cut costs, right? They cut about 2,500 to 3,000 people. That's the plan over the next 12 to 18 months. That's supposed to lower the cost structure by about 500 basis points to have OPEX to sales from 24% to about 19% for the year. Now, the closest comp would be Dell, and Dell is running around 15% OPEX to sales. So I think, Elliott is trying to look for a little bit more than 19% OPEX to sales to drive up the earnings going forward.
So is this just a cost story from Elliott's perspective, or is there something Hewlett should be doing they're not doing from a revenue perspective?
Yeah, from a revenue perspective, I mean, if we turn back to last quarter, there was a really big execution faux pas in terms of they mispriced their servers. If you're an investor, I mean, how does a company misprice servers to really screw up the rest of the year from a pricing standpoint and from a margin standpoint? So, I wouldn't be surprised if Elliott is looking for a management change as well, because Hewlett Packard has lagged what Dell has done from an AI server perspective, they really haven't gained material share on the networking side nor on the storage side against some of their closest comps.
Well, Elliott has a really successful track record, from Salesforce to Citrix Systems, a few others. How are people really receiving this right now? Are investors happy?
Some of the calls that I've received initially off the print, Nora, was is the Juniper deal off the table as a result? I don't think so. The one thing I will add was that Elliott was a stakeholder of Juniper multiple years back, and they did extract more dividends from Juniper as part of being a stakeholder. They may, I wouldn't be surprised if Elliott wants a board seat to guide the management going forward. But I do think that the HPE Juniper deal is still going to be on track.
Our thanks to Jin Ho, Bloomberg Intelligence Senior Technology Analyst.
Coming up on the program, we'll break down how the tech company Intel is now making good on its plans to start spinning off non-core assets.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Norma Linda. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Paul Sweeney.
And I'm Norma Linda, filling in for Alex Steele. We move next to the tech sector.
The tech company Intel is now making good on plans to start spinning off non-core assets. This week, Intel agreed to sell a 51% stake in its programmable chips unit, Altera, to the private equity firm Silver Lake Management.
The transaction values Altera at $8.75 billion, and that's about half of what Intel paid for it a decade ago. The deal is expected to close in the second half of 2025.
For more, guest host Emily Grafeo and I were joined by Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst. We first asked Mandeep what Intel is up to these days.
Well, they got a new CEO, and I think he's making the moves. Everyone was looking forward to what is he going to do differently than Pat Gelsinger, and it looks like he wants to turn around the foundry business. There was one school of thought that thought Intel should sell the foundry and focus on chip design like NVIDIA, but clearly he feels, foundry business can be turned around. And so the easy pickings here is raise cash, get rid of the non-core assets, which is Altera here. So they're selling 51% stake. Mobilize another business that comes to mind that they could sell. And look, with a company like Intel, everyone knows that, you can't really turn around this company to show high growth. It's more about how do you manage the company in a way where they're not burning a lot of cash, as well as they can have, low to mid-single digit growth. And I think that's going to be the playbook here.
So Mandeep, is Silver Lake getting a good deal then with this acquisition?
I think so. I mean, Intel paid, $16 billion plus 10 years back. So they held the company for 10 years, and now they're selling at half the price. And look, this isn't a high growth asset, which is why it was non-core to Intel. But we know semis isn't that sweet part of the cycle where everyone seems to be bullish on AI and semis. And so maybe Silver Lake can come up with a better way to, leverage Altera in that semi space, because that's what everyone seems to be excited by. How can I play in the demand for semis?
Why didn't they sell the whole thing?
Well, I mean, it's a private equity player, so they're not going to put a lot of money in one asset, and they just wanted 51% so that they can run the company. At the same time, Intel can benefit if they are able to successfully turn it around. And I think Altera still needs Intel technology to be successful. So it's not as if there's a complete decoupling. It just allows Intel to focus more on the core business, the foundry, and their CPU business, as opposed to focusing on Altera and Mobileye, I think, good down the line.
Should we expect with this new Intel CEO to see more news like this, Intel selling other parts of its business?
I think so. Mobileye is definitely another one, which is non-core to Intel, even if they want to double down on AI and chip design within AI. I mean, Mobileye is more autonomous driving. And that also came from another acquisition that Intel did back in the day. So I hope they don't end up taking a loss on that one. But I do think the playbook here seems to be that they want to focus on foundry and core CPU chip design.
Foundry, that's making chips, right?
Yes, the manufacturing side.
Now, who else does that?
Well, we heard the news around NVIDIA, using TSMC to make their AI supercomputers here in the US. So that was quite a bit of news, because I would have thought TSMC would partner with Intel, and there was some rumblings about, TSMC doing something with Intel, at least here in the US. But it looks like NVIDIA is thinking about making their next AI supercomputer with TSMC. No talk about Intel. And that will be here in the U.S.
I thought we invested. I thought there's some deal out there where Intel's gonna do a bunch of that stuff.
Yeah, so that's where there was talk about Intel and TSMC partnering.
Okay.
So that was the foundry side of Intel, but I don't think that's happening now.
So the Biden plan with Intel, which was to do a big deal, big investment, is that still on or no?
So the CHIPS Act money was given to Intel. It was also given to TSMC for the Phoenix fab, where they will be making this AI supercomputer with NVIDIA. But look, I think in the case of Intel, the challenge has always been, why have they not participated in this AI wave? And the CHIPS Act money didn't help over there.
Our thanks to Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst.
Staying with the tech sector, we recently learned that tech giant Apple has been exempted from 125% tariffs on goods produced in China. This includes iPhones, iPads, Macs, Apple Watches, and AirTags.
Separately, we learned that Apple will begin analyzing data on customers' devices in a bid to improve its AI platform.
For more on this and all things Apple, Nora and I were joined by Mark Gurman, Bloomberg News managing editor for Global Consumer Tech. We first asked Mark how he thinks Apple will adjust to Washington policy moving forward.
That's the big question. We're on a bit of a roller coaster here, where Apple's constantly needing to think about adjusting, and then how are they going to adjust, and then what happens if they adjust, and then they have to adjust in a different direction. You can really think of Apple as just like the biggest ship in the water. It's going to take a while to move anything. So these adjustments, they have to be made with precision, right? And so it's a sporadic situation. You really don't know what's going to happen, but at least for now, they're in good shape. But who knows how long that's going to last. But no matter what Trump does moving forward, I'd be very surprised if he talks about this sectoral tariff on these types of devices. Maybe I'm wrong. I just don't think there's any way it's going to be the 145%. So either way, you're still at a big improvement.
Of course, with the tariffs as an added layer of a headwind for the company, they're not stockpiling. And so we're seeing them increasing shipments and everything, but it seems as though this isn't necessarily due to more demand, but more or less the fact that they're just trying to prepare for the worst. Is that the case?
Yeah, that's right. Trying to get as many phones at no tariffs or at low tariffs as possible, whether it's from China during this period right now with no tariff, whether it's from India at this period with the lower tariff. Get as many as you can into the U.S. channel to fulfill demand. The problem is that we're about to go through a product transition, right? They're about to move to the iPhone 17. So the question,
I just got the 16, dude.
I'm behind.
Yeah, that's fine.
Here,
but the point we're trying to make here, yes, you are behind. You're also behind. But the point that I'm trying to make here is that these iPhone 17s are not ready to be pumped out. So the question is, what is the tariff situation going to be in September, October, when these things are flying off the manufacturing lines? Where are these going to come from? So at this point, it's so difficult to figure out what's going to happen. What do they need to do?
In reality, I can't imagine China not being an integral part of Apple in the next 5 years. I mean, it has to, right? You can't switch.
Nothing's changing. Well, that's not true. Things are changing, but China's not going away. Right? Don't forget that the U.S. makes up about, a third of Apple's overall sales. You still got 2/3 of the world that's going to rely on this China supply chain. China is critical for the rest of the world.
So how's Apple doing in the AI game right now? I mean, so I know we have iOS. What's going on there? I know we have iOS 18.5 or something coming soon.
That's coming, but Apple AI is not doing so hot.
Okay.
They just replaced the person in charge of Siri, right? They're pulling any lever they can. One of the issues with Apple Intelligence is that their privacy stance has prevented them from gathering as much data possible in order to train their AI models. To get AI models working properly, you have to train them with data, right? And the best data you can get is the data that your customers are inputting into their iPhones. They don't do that. OpenAI does it, Google does it. That's why their tools are so great. What Apple's doing now is they're putting in this new privacy-centric approach where they're going to take your data on your phone, analyze it on the phone, compare it to the fake data right? They use fake data that they just create out of thin air, well, using AI, compare it so they know which fake data is most similar to the real data, and then they'll use that best of the bunch fake data to train their AI model. So you're seeing
that
these.
seems complicated.
I know, right?
It is complicated, hard to wrap your head around, and so they're basically pulling every lever they can.
Now, we've said in the past, Apple doesn't need to be first in things because they just need to wait till the technology's kind of out there, and then they're going to come in and make it beautiful. Is that still hold for AI?
That's the problem. The usual playbook, you're right. Don't be first, be the best. Well, they're certainly not first.
Okay.
And they're probably the worst.
Wow.
Of all the big tech names. They are the worst in AI of all the big tech names.
How concerned are they at
Right.
Cupertino about
I mean,
that?
it's extremely concerning. They were going to have the head of AI retire, perhaps. He's not going anywhere. They just replaced him on Siri. There's certainly a lot of work and accountability that needs to be done there. And the question is, how long is it going to take till you have something compelling? And I do think it's going to be at least a few years. But don't forget, AI is not the phone. The phone moved fast. But there was new innovation in the phone maybe, every year, every couple of years. AI, you're getting a new DeepSeek every 3 weeks. Wow. There could be a big AI innovation announced tomorrow. In fact, I think OpenAI just rolled something out, ChatGPT 4.1 model the other day or yesterday. And so the speed that this moves at is what's really concerning, because Apple just doesn't move at that speed. They're not built to operate at the speed of these
Can
other AI
they
companies.
buy their way into this market?
I think they can, but that would also require a big sea change, because Apple's historically bad at integrating larger companies into their overall operational workforce. And so it's like you take a step back and you ask yourself, what is Apple really good at? They're good at the phone. They're good at the iPad. They're good at the watch. They're good at health stuff. They're good at core on-device software. Not really good at cloud, though they have some excellent cloud-based services at this point. Not really good at AI. They're getting good at TV from, what I hear from people who like their shows. But they're just a company at this point that's running based on legacy ideals, and they need a bit of modernization. And the question is that going to happen? Don't forget, this company is run by the same group of people
I
who've
was just
been
going to
there.
ask, does Tim Cook still have the support of the street and of the board? And
Oh,
of
yeah.
Silicon
That's,
Valley?
Tim Cook wouldn't write his own ticket. There's no question there. They're down 19% this year.
Right.
But look how much they're up over the last 15 years. What he's done is amazing. Everyone counted him out after Steve Jobs passed away, right? Steve Jobs is a one-of-one innovator in mind on this type of thing. And it would have been very easy and not surprising if, Apple not folded up shop, but really moved away from what they were.
Yep.
And in many respects, they have moved away. But at the same time, they've grown so much.
Yep.
The way Apple's at the center of all our lives today was not the way they were at the center of our lives 10 years ago. They were not at the center of the universe a decade ago.
Yep.
They're at the center of the universe today.
Yep.
Because Steve Jobs left them with a lot of momentum. And Tim Cook executed better than anyone else would have been able to execute.
Our thanks to Mark Gurman, Bloomberg News Managing Editor for Global Consumer Tech.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.